Hello and welcome to traders and investors, and I'm glad to present you the daily market review prepared by analysts and experts from fx.co portal. Here we go. And we're starting with EURUSD as usual. Let's discuss the trading plan with Miroslav Bawulski. Yesterday, the ECB raised its benchmark interest rate by 25 basis points to 2.25%, becoming the first major central bank to tighten monetary policy in direct response to the conflict with Iran. However, the euro largely ignored the decision, gaining ground only after Donald Trump stated that the United States had no plans for further strikes against Iran. In the first half of today's session, traders will focus on CPI data from Germany, Italy and Spain, while Eurozone finance ministers are also set to meet. Weak inflation readings could quickly bring selling pressure back to the euro. In that scenario, the key support level to watch is 1.1556. A false breakout there would provide a potential long entry, targeting a recovery toward 1588, yesterday's closing resistance. A breakout above this level followed by a successful retest would confirm bullish momentum and open the door for a stronger move toward 1617. The final upside target stands at 1645. Where profit taking is likely. If EURUSD moves lower and buyers fail to defend 1556, bearish pressure on the euro is expected to intensify, increasing the risk of a deeper decline toward 1529. Only a false breakout at that level would justify fresh long positions. Otherwise, aggressive rebound can be considered from 1506, targeting a 30-35 pip intraday recovery. To keep EURUSD trapped inside its current trading range, sellers will need to step up their game today. If the pair moves higher and reacts positively to the European data releases, the key resistance to watch is 1.1588. A false breakout there would provide an attractive short entry, targeting a decline back towards support 1556. A decisive break and close below that level, followed by a successful retest from the underneath, would confirm renewed bearish momentum and likely trigger a broader euro sell-off, opening the door for a move toward 1529. The final downside target stands at 1506, where profit taken on short positions is likely. On the other hand, if EURUSD extends its gains and bears fail to defend 1588, the euro could stage a much stronger recovery. In that scenario, it makes sense to delay fresh shorts until the next major resistance, 1617. Only look to sell there after a failed breakout and rejection. As for aggressive fade trades, short positions on the direct rebound from 1645 remain in play, targeting a 30-35 pip intraday pullback. And we're starting with pound sterling dollar pair with thin low. On the early chart, GBPUSD consolidated below the 33.49-33.55 support level, but failed to extend its decline and returned to the 50% Fibonacci retracement level at 1.3408 by the end of the day. A consolidation above this level would allow the pound to continue rising toward the 34.54-34.66 resistance level. A rebound from the 34.08 level would once again support expectations of a decline toward the 33.49-33.55 level or lower. the wave structure remains bearish, as both still lacks sufficient positive geopolitical news to launch a full-scale advance. The most recently completed upper wave failed to break the previous peg, while the latest downward wave broke the previous low. The geopolitical backdrop is currently highly uncertain, giving neither bulls nor bears a clear advantage. The bearish trend can be considered complete only after the June 5 high is surpassed. On the 4-hour chart, GBPUSD rebounded from the 23% Fibonacci retracement level at 33.27 and advanced toward 38 Fibonacci level at 34.29. A rebound from this level would favor the US dollar and imply a moderate decline toward 33.27. A consolidation above 34.29 would increase the likelihood of further gains for the pound. No emerging divergences are currently observed on any indicator. That's all for today. See you online soon.